Hey everyone! Welcome back to Capital Compass, your go-to channel for daily insights on global financial markets. Today, we're diving into what's rocking the U.S. stock market right now, and it's big. From record-breaking tariffs to looming recession fears and the Fed facing major pressure, there's a lot to unpack. Let's start with the elephant in the room. The S&P 500 has dropped for the fourth day in a row, sliding below 5,000 points. That's nearly $5.8 trillion wiped out in value since the new trade measures were announced. The biggest factor? A 104% tariff on Chinese imports. Yes, you heard that right. This is the sharpest tariff move we've seen in years, triggering fears of a full-blown trade war. China has hit back, warning of countermeasures and pushing businesses globally into defensive mode. With the markets in turmoil, President Trump is turning up the heat on the Federal Reserve, urging Chair Jerome Powell to slash interest rates immediately. But Powell isn't budging, at least not yet. He's signaled caution, noting that the Fed wants to wait and see how the economy reacts before making a move. Meanwhile, traders are betting the Fed will start cutting as early as May, pricing in multiple rate cuts this year. So, what's the real fear here? Two words: stagflation and recession. With inflation staying sticky and growth slowing down, analysts are now assigning a 60% probability of a recession. That's up from 24% just weeks ago. The concern isn't just economic decline, it's inflation without growth. A nightmare combo that's hard to fight with policy tools. Next up, big bank earnings are on deck, and analysts expect them to be underwhelming. Why? Banks are now expected to raise their loan loss reserves, prepping for a possible wave of defaults if the recession hits. This could further spook the markets and create pressure on the financial sector, which is already under stress. Now here's a curveball. Even with all this talk of rate cuts, the 10-year Treasury yield is rising. Why? Investors are worried that inflation might stay elevated, and they're not confident that rate cuts will do the trick. This is a major disconnect between markets and Fed policy. It's a warning signal. When bond markets and central banks aren't aligned, volatility follows. So with all this happening, what's the smart move? Stay away from overexposed sectors like global tech and cyclical exports. Watch for entry points in consumer staples, healthcare, and utilities. Keep an eye on bond market signals. They're telling a different story than equities. Be patient. The market may bounce, but we're not out of the woods. That's it for today's breakdown of the U.S. financial market. The good, the bad, and the ugly. Let me know in the comments. Do you think the Fed will cut rates soon? Or is the worst yet to come? Don't forget to like, share, and subscribe to Capital Compass for more real-time financial updates. And hit the bell. You won't want to miss our next market analysis.